All right, everyone, are we live? I think we're live. In today's video, I'm going to talk about the deteriorating labor market conditions that exist in America and the fact that Americans now have their worst sentiment on the labor market since 2009. This was a new report today that just came out from the University of Michigan, and the Wall Street Journal talked about it. Consumer sentiment just unexpectedly weakened in September. This is a big warning you all need to be paying attention to. In particular, consumer sentiment dropped as Americans anticipate job market risks. And what we're seeing specifically is that Americans are now expecting unemployment rate to rise at their highest rate since 2009. So over 60% of Americans, the red line, now think the unemployment rate's going to go up over the next 12 months. The last time we saw anything like this in terms of labor market pessimism was the 2009 financial crisis. In addition, one additional data point you got to pay attention to is the dotted line. Over 20% of Americans think that they're going to lose their job in the next 5 years as well. So this labor market pessimism among Americans, it's building and building, and it's suggesting we could be seeing real weakness underlying the economy right now. It's also suggesting we could see the housing market start to roll over even more over the next 12 months if this labor market deterioration actually turns into real job losses. Because the one thing you guys got to understand about the economy vis-a-vis the housing market right now is that we're starting to see home prices drop in half the US, while the unemployment rate is still at a very low level. So the unemployment rate in America right now, everyone, is around 4.3%. That's the U3 unemployment rate, 4.3%. Now you can see it's gone up from 3.4% in 2023 up to 4.3%. But that's still a very historically low level, this yellow dotted line. You can actually see that the long-term average unemployment rate in America is actually 5.7%, the gray line. So could we be seeing unemployment continue its slow march upward to its long-term average or even above the long-term average? And if it does, is that going to drive home values down further in the future? I know a lot of people think like there's not going to be a recession at this point. A lot of people think the housing market's never going to crash. A lot of people think the stock market's never going to crash. But for the people who think that, the one thing I want you to understand is that's all in the context of an unemployment rate that's still near a record low. What would happen to the economy, housing market, and stock market if the unemployment rate were to double to 8%? Or what if it were to go up to 7%? I suspect if it did, and you can let me know what you think, guys, I suspect if it did, we would see stock prices, asset prices go down by a lot. Home prices go down by a lot. Because this economy has kind of been patched together over the last several years, right? And this didn't start in the Trump administration. This actually started in the Biden administration. You know, a lot of houses went on the market for sale 2021, 2022 at record prices, right? Well, now we're starting to see the sellers cut the price. You can see this is a listing outside of Phoenix, everyone, that I just found. It's a 3-bed, 2-bath, 1,600 square feet, $375,000. The seller on this house just did a $50,000 price cut over 3 months. They originally listed at $425,000. Now they're at $375,000 for a house that looks okay on the inside. I wouldn't say it's my favorite interior. It looks very Southwest, right? Tile everywhere. It's probably, really hot in Phoenix and Glendale. This is a kind of a standard type of house. 3-bed, 2-bath, 1,600 square feet. They just did a $25,000 price cut. They've cut the price $50,000 already. And my point here is, everyone, we're seeing these price cuts come about on the housing market while the unemployment rate is still only at 4.3%. And now we have Americans, actual Americans, saying that the unemployment rate's going to go up more in the future and that they fear losing their jobs. And, the upside to all of this, everyone, if this were to play out, if Americans are right in terms of their projections on where the economy is heading, the upside is it's going to mean cheaper prices for you in the future. It's going to mean more people forced to sell their house. It's going to mean maybe more foreclosures, more mortgage defaults. A lot of people think that those things aren't good, but I actually think the housing market could use a little bit of that to shake things loose and cause prices to go down by more in the future. Because make no mistake, everyone, home prices are still near a record high on a national basis. Like some cities are in a crash, Austin, Tampa, even Dallas is now starting to roll over. But on a national basis, it's still really expensive to buy a house. In fact, Zillow just released a report couple days ago, talking about how the aggregate value of the housing market is now up to $55 trillion. 55 trillion for the aggregate value of the housing market. And so for many people who bought into the market over the last 20 years, you're saying, oh, real estate might be the best thing ever because we're up to a 55 trillion cumulative housing market value, according to Zillow. They're actually showing all the different states in their housing market value. One thing Zillow is talking about is that there's a regional rebalancing taking place. Home values are going up, for instance, in New York, but going down in San Francisco and Dallas. So there is a regional rebalancing taking place. But the overall thing to understand if you're a home buyer, right, is that if you were to buy into this market today, you're buying at a level of homeowner equity and home value that we've just never seen before in US history. Like, this is a graph of the homeowner equity in the US. How much equity homeowners have, which is 35 trillion. So if you take the 55 trillion from Zillow on value, subtract the mortgage debt, you get the 35 trillion in homeowner equity. That's an all-time high. So if you're buying into the market today, you're buying at a very high price. Back in 2006, we only had 14 trillion of homeowner equity. Today, we have 35 trillion in homeowner equity. And homeowner equity as a percentage of GDP, homeowner equity divided by GDP, is at 117% today, indicating that we're in a housing market bubble. Right? This is indicating just how expensive it is to buy a house today. This is indicating just how much equity existing owners and sellers are holding on to and how much equity they can afford to give up in order to bring a balance back into the housing market. And so, one comment I consistently hear from people out there is they say, home prices won't go down. They say home prices won't go down because, and you guys can tell me if you've heard someone say this. It's like a very common argument. They say home prices won't go down because of inflation. Or they say home prices won't go down because, the economy is strong, is what some people say. But understand that home prices and homeowner equity related to the size of our economy, GDP, is 117-18%, meaning that there isn't much fundamental justification for today's home values, whether you're talking about inflation, whether you're talking about income, whether you're even talking about money supply. There isn't actually real fundamental justification because those things are not translating to the economy growing fast enough to support today's housing market, which is expressed on this graph. And ultimately, the takeaway from this graph for you, if you're a buyer, right, or an investor, is that you got to be wary buying in at this price, at this point. If you do buy today, try to get a good deal. Try to negotiate with the seller. Try to get a discount. Or try to buy a house where they're already doing big price cuts. See if you can grind them down by more, because this homeowner equity graph is a scary one if you're looking to buy a house in today's market. But of course, a big question is, where is the labor market heading, right? The lead to this video is talking about consumer sentiment and consumer sentiment on the labor market. And I want to talk a little bit about that data because it's very instructive for you in terms of understanding what's actually going on, right? Because there's almost two different sides to this economy right now. There's the one side, which I'm going to call reality. And in reality, the economy is tough. This is a tough economy that we're in right now. The job market is weak. Wage growth is okay. It's around 3.5%. It's not great, but it's not bad. Inflation is stubbornly elevated at 2.7%, and asset prices are really high, meaning that if you're not someone who was already, in all of this stuff 5 to 10 years ago, you're looking at this economy and saying it's not so good. But then there's the other side, right? The people who make their money off asset prices going high, the people who make their money off, the party continuing, they're coming up with every excuse in the book about why this economy is healthy and that there's going to be no downturn. And they're really, on the opposite end of what I would say regular Americans are feeling. And I actually, polled you all on this channel because I was curious about what you were feeling about the economy. Like, how are you feeling about where things are going to go in the future? And I asked you all the question, do you have a positive or negative outlook on where the economy is heading the next 12 months? And the answers to the poll was very interesting. Actually, 16,000 of you voted in this poll. It's amazing when I run these polls here on my YouTube channel, how many of you actually end up voting. The sample size for these polls is often 10 times higher than some of the official polls that you see out there, and the results can be very interesting. And so if we take a look here, what's your outlook on the economy over the next 12 months was my question to you all. Let's actually zoom in on this so you guys can kind of dig into it. What's your outlook on the economy over the next 12 months? I asked this 2 days ago. Well, 16% of you have a positive outlook on the economy. 16%. Not even 1 out of 5 of you watching has a positive outlook on the economy. 19% of you have a neutral outlook on the economy. And then 65% of you have a negative outlook on the economy. So 2/3 of you watching don't feel like the economy is in a good place or will go to a good place over the next year. Now, I've run these polls before, and sometimes people say, hey, Nick, well, aren't your viewers more pessimistic in general about where things are going on? Maybe it's not an accurate sample of people. But what's amazing, actually, is your responses to my poll on this YouTube channel are roughly consistent with the University of Michigan Consumer Sentiment Survey. It just seems like American consumers overall are negative, whether you're watching my channel and answering the poll on YouTube, or whether people are being polled by the University of Michigan. You can see here the University of Michigan Consumer Sentiment Survey. We have an index right now of a 55. This is one of the lowest levels of consumer sentiment we have ever seen on the economy. The only other times it's been lower were in April and May after tariffs were announced, in June 2022 when we had that big spout of inflation, 2008 during the crash, and then the double dip recession in 1980. Literally only 3 or 4 other times have we ever seen consumer sentiment this low. And so what this is showing you, everyone, is how Americans are actually truly feeling about their economic prospects, about their financial prospects over the next year. And I think a lot of people try very hard to try to tell you that this isn't the case. A lot of people try very hard to say, oh, maybe this University of Michigan survey doesn't matter because it's politically biased. I hear people say that. Some people say the University of Michigan survey is run by progressives and liberals who are trying to paint Trump in a bad light. However, what's really interesting is that you guys on this channel, you guys tend to lean more independent or conservative. And 2/3 of you also have a negative outlook on the economy. And just the reason I'm spending so much time on this is so you guys can have an accurate picture of how Americans actually feel about what's going on. You aren't crazy if you have this negative outlook, like most other people do, but the mainstream news and the people in the stock market and the people who make money off real estate, they want to obfuscate that. They want to kind of try to like make that unclear, and they want to try to say, no, everything is good. And, I think a lot of it just comes down to 2 things: wage growth and job prospects, right? Like if you feel like you're going to get a big raise next year and that your job is secure, you're going to feel good about the economy. You're probably going to buy a house in the next couple of years if you feel that way. Conversely, if you feel like your job is not maybe solid, you feel like you might not have your job, if you're one of the 23% of Americans who thinks you're going to lose your job in the next 5 years, you're not going to run out and buy a house. And, one of the things that I think is really interesting about this economy is the jobs figures. Like we just saw earlier this week, job growth was revised down by 911,000 through March 2025. Job growth revised down by 911,000 through March 2025. So again, I want you all to think about this. The Bureau of Labor Statistics does their monthly job figures, right? And then each year they do what's called a benchmark revision. And they did the initial estimates for the benchmark revision. And this basically cut 1 million jobs from all those job growth reports you heard about in the last year. 1 million jobs were just cut from them, suggesting the economy is way weaker than people think. Right? And suggesting that Americans aren't crazy and haven't been crazy over the last year when they've been reporting that things aren't so good. Now, what's interesting is you could actually see the breaking news headline here at the top of the screen on CNBC is saying NASDAQ closes at record high. And this is just so funny, kind of the juxtaposition. Job growth revised down by 911,000, but NASDAQ closes at record high. S&P notches winning week as Fed decision looms. So we had just a million jobs cut earlier this week from the revisions. We have consumer sentiment in the basement. We have almost two-thirds of Americans expecting unemployment to go up. We have two-thirds of you guys with a negative outlook on the economy, yet the NASDAQ keeps going up. And I wonder why. Why does the NASDAQ keep going up when it's obvious that the economy is on shaky ground? Well, I thought this was an interesting article to help explain it that I want to show you guys because I think it explains what's going on in tech. It explains what's going on with big business. And this article is about how Open Doors board chair I think it's Keith Rabois, or Rabois, if it's French. If it's French, it's Rabois. Maybe it's Rabois. Keith Rabois said the company is bloated, needs to cut 85% of workforce. So for those of you that don't know, Open Door is the big Wall Street home buyer. I've covered them a lot on this channel, and they're actually a meme stock right now. Open Door's stock price over the last 6 months is up 664%. This is the Reddit Wall Street meme traders have jumped on Open Door. I don't know if they actually think it's a good company to buy or if it's just like the in vogue stock. But you can see like Open Door's stock price collapsed by 99% basically over 3 or 4 years and then became a meme stock in June. And now its price is surging back up as a result. And they just appointed a new chairman, new CEO. And anyway, here's what Keith Rabois, the chairman, is saying. Open Door is bloated and needs to cut 85% of its workforce. 85% of its workforce needs to be cut, is what he's saying. More specifically, he said, let's just zoom in on this. He said there's 1,400 employees at Open Door. I don't know what most of them do. We don't need more than 200 of them. I want you all to think about that statement coming from the board chair of Open Door, publicly traded, largest home buyer in America, is saying we don't need 85% of our employees. Now, I don't know Open Door's business as well as their board chair. I do know what, their business overall. To say that you can cut 85% of your workforce as a large publicly traded company being the largest home buyer in America, I don't know. It seems like a kind of like a big claim. And what I think it evidences is how Wall Street is just like ruthless right now. The big publicly traded companies are just, you're going to lay people off left and right. They don't really care about like their employees at all. I mean, they don't care about their employees at all. And I think a lot of them are now using AI to streamline workforce and they're just trying to cut costs on expenses. And so this could be why the stock market keeps going up, even though the labor market prospects keep going down, is that if you as a publicly traded company can lower your expenses enough, you could potentially increase your profit margin, even if your overall business isn't doing very well. And Open Door's business is not doing very well. Their revenue's down something like 60, 70% over the last 2 to 3 years. But maybe if they cut costs enough, they could turn profitable or more profitable, and then they'll be rewarded in the stock market. And I think that's just the overall trend we're seeing that helps explain why there's this bifurcation, right? This bifurcation of the stock prices keep going up, but we keep seeing layoff announcements. We keep seeing negativity on the labor market. I think most of you know if you're in a white-collar job especially, clutch onto that white-collar job right now because a lot of them are getting eliminated. And essentially what this means, because I want you all to understand this, because it can be a confusing point. The earnings growth of the companies keeps going up. The earnings growth keeps going up, so the stock prices are holding on. And this is a very important point to understand, because if you want to actually know, like, when is the stock market going to roll over? Like, when are we going to get to a point where like the stock market's going to roll over? When are we going to get to a point where maybe we start seeing like big mass layoffs? Well, look at this graph. This graph is going to tell you a lot. This graph is looking at data on earnings growth over the last 70 years, the green line, versus jobs growth, the orange line. And you can see a couple things. One, earnings growth of companies, the green line, and jobs growth in the economy, the orange line, used to be much more correlated with each other. Like, check this out. I'm just going to take my video off the screen for a second. Going back to 1948, you could see they were very correlated with each other in the economic cycles. But then something started happening in the late 80s which is really interesting. In the late 80s, everyone, earnings growth started like spiking way above job growth and then plummeting way below job growth. Like earnings growth just became increasingly volatile. Look at how volatile earnings growth is actually becoming. Every economic cycle since the late 80s, earnings growth is getting more and more volatile than job growth. Now, let's fast forward to the last 10 years. And I want to zoom in on this for you so you can understand what needs to happen for stock prices to actually start coming down, what needs to happen for the recession to actually feel real. I want you all to understand this really, really well. So you could see earnings growth spiked in 2021, went down in 2022, has recovered, and we're at around 13% earnings growth year over year for publicly traded companies. Job growth, though, on the other hand, is decelerating. So we're at around 1% jobs growth. We're actually at 0.9% jobs growth year over year in August. So the job growth is decelerating like it would prior to a recession, but the earnings growth is actually holding on and even improving. The earnings growth is even improving. And I think that earnings growth is improving. Why is it improving when the job growth is declining? Well, they're actually probably related. The Wall Street companies, the big publicly traded companies, are now figuring out they can use AI to lay people off and not hire people or force them to resign by calling them back into the office, cut their workforce, and their earnings will go up as AI can take the place of these employees or future employees. And that is the economy we are in right now. That is the reason why we haven't seen the big crash, coupled with the fact that the government keeps spending all this money, the deficit keeps exploding. Those two things together are just propping things up. And just one has to wonder, how sustainable is that at a certain point? If enough people lose their job or feel insecure about their job, will consumer spending finally be cut back? You guys can let me know what you think about that. If consumer spending finally gets cut back, if enough people feel insecure about their employment, that would cause earnings growth to go down. If consumer spending gets cut back, revenue growth would decline and margins would decline, earnings would go down, stock prices would go down. But we haven't yet seen that because the spending has been sort of like supported. The spending's been supported by the top 10, 20% of earners. And so there's just kind of this almost suspension of this strange economy where the wealthiest people continue spending. The other 80% feel like this economy is really not good and wants things to correct, but it's just not happening because the top 80%, or I should say the top 20% continues to spend. And this is a live stream, by the way, everyone. I'm live. If you're a channel member, feel free to leave a message in the chat if you want me to cover a certain area. But I'm just going to shift now to the housing market. What does all this mean for home prices, right? And what do we need to see in terms of housing market inventory, housing market supply? What do we need to see to bring affordability back into the market? Well, looks like I have to sign in to my Reventure app account before I see. This is the wonderful thing about going live, is you don't have everything set up. All right. What do we need to see real affordability come back to the housing market? When are we going to see the crash in the housing market? Well, I want to actually point you all to a metric that I developed to help you all with this. Salary to afford a house. How much money do you need to afford a house in all the different states? That's what we're looking at on this graph. What median income, what salary do you need to earn to be able to afford a house with today's mortgage payments at a 30% payment to income ratio? This is a data point that's really important for you all. The worst state actually isn't California. The worst state is Hawaii, everyone. In Hawaii, you need to make over $200,000 to be able to afford a house. Just the basic house, your income needs to be $200,000 in Hawaii. In California, it needs to be around $200,000 as well. So those are the two states that are the most expensive. And if we actually look at the historical graph on California, it's really, really interesting. Like prior to the pandemic, California was expensive, but you could afford to buy a house in California if you made 100 grand. If you made 100 grand prior to the pandemic in California, you could afford to buy a house. Now you need to make 200 grand, and that's just across the state overall. Like in LA and San Francisco, obviously need to make more. But another state that's interesting is Nevada. So in Nevada, everyone, and my screen is really big here. In Nevada, you need to make $113,000 to buy a house. Wow. $113,000 to buy a house in Nevada? Does anyone in Nevada, I mean, Nevada's a pretty like tourist-centric state with service jobs. Like, who, how many people make 100,000 in Nevada? Well, not that many. Median income in Nevada is 80,000. The median income is 80,000. You need to make 113,000 to afford to buy a house. And you can see this wasn't always the case in Nevada. From 2009 to 2021, the median income was actually higher than the salary needed to afford a house. And this is where stuff gets crazy on the housing market. Like, if we download this data here from Reventure app and we open it up, take a look at this, everyone. In Nevada, and we're going to cover some other states here in a second, but just take a look at what this data says. How much money you needed to make in Nevada in all these different time periods to be able to afford to buy a house. In 2012, this is absolutely crazy. In 2012, you could buy a house in Nevada on a salary of $23,000 a year. $23,000 a year. If you had made $23,000 a year in Nevada in 2012, you could actually afford to buy a house. You could qualify for a mortgage if you made $23,000 back in 2023. But of course now, what is it? 113,000. That's wild. And people wonder why the home buyer demand is so low. People wonder why no one's buying houses in Nevada. Why is the demand in Las Vegas to buy houses at the lowest level literally since 2008? Well, it's because you need to make $113,000 to be able to afford to buy a house, and very few people there make that type of money. Of course, another interesting state for this stat, everyone, another really interesting state for this stat is Florida. Florida is a very interesting state as well, similar to Nevada. Can you guys guess how much money you need to make in Florida to buy a house? Let's see if you can guess. If you squint your eyes here, you could see it. You need to now make $99,000 in the state of Florida to even really like qualify for a mortgage to buy. 99,000 in Florida. This is a place that was like pretty affordable until recently. Let's look at the historical graph. Wow. So again, from 09 to 2021, the median income in Florida was above the salary needed to afford to buy. Now it's way reversed. You need to make 99,000 to buy a house in Florida. The median income there is 77,000. And why I'm showing you this data and this graph, everyone, is because if you're trying to figure out, like, when's the point in time where it's going to be just in general a good time to buy in my area, this is a great graph to look at. It's these two lines. When does the salary to afford a house line cross below the median income line? We can also look at this monthly too. You can look at this month by month on Reventure app. This is a premium data point that I would encourage a lot of you guys to check out after this video. We have it down to the zip code level. If we see that salary to afford a house eventually go down below the median household income line, that's a signal to you affordability has been restored to the market. That's a signal to you that, you know, it might keep going down even after that, but at least we get to a point where you could start saying, hey, maybe it looks affordable. Hey, maybe this is something that feels like it could be a good idea if I could, buy a house when this green line, salary to afford a house, goes down below the gray line, median household income. And what I'm going to do right now, everyone, is I'm just going to run through. I'm going to do a little rapid fire round. I'm going to try to take some of your requests, but I'm going to just do a rapid fire round in terms of different cities, doing a little housing market update on some different cities in the US that I think are really interesting right now, giving some forecasts and projections about where prices are heading. I'm going to try to cover your city. We're going to do this really, really quick. So what I want to do is I'm going to go on Reventure app, and I'm going to shift here to the Metro view. We're going to shift to the Metro view, and we're going to start by asking a simple question. Where are home prices down the most over the last year? Where have prices dropped the most in the US over the last year? We talked about in the beginning, housing market value is 55 trillion. We're still in a bubble. But prices are going down in these areas in blue. And what you can see is it's Florida, everyone. It's Texas. It's even now parts of Southern California. I just did a live stream on how San Diego is now entering a correction. We're even seeing values now drop in Atlanta. We're seeing values drop in Raleigh, North Carolina. We're seeing the correction really begin to play out in this part of America. For instance, a market like Dallas. I'll start with Dallas. One of you asked me in a live stream the other day, is Dallas crashing? Well, I don't know if you could say it's crashing yet, but values there are down 3.5% over the last year. So values are already down over the last year. And our forecast over the next year is minus 7.6% in Dallas. So if you open up the scorecard on ReVenture app, everyone, you could see our home price forecast score for your area, for your city, your zip code. Minus 7.6% in DFW is what we think is going to happen in the next 12 months. We're already down 3.5. So that would be minus 11 over 2 years if our forecast comes to fruition. You could see we're now in a heavy buyer's market in DFW. That's good news. That means, ultimately, folks, you could take this forecast. You know what you could actually do, everyone? You could download the report and show it to the seller, show it to the listing agent, try to negotiate a cheaper price in Dallas, because this is a market that's definitely heading down. Definitely heading down. Lots of inventory in DFW. Prices already dropping. Now, what about some other cities? What about Denver? Denver is a really interesting market, everyone. Denver is down 2.6% over the last 12 months. So Denver is already going down. These declines are already happening, right? So some people are trying to tell you like there's no home price correction. No, no, no. These prices are already going down according to data from Zillow as well as data from Realtor.com. Both sources support price declines in a market like Denver. What do we think in ReVenture over the next year? Oh my goodness. Minus 9.7% is our ReVenture forecast for Denver over the next 12 months. Now, one thing you guys got to do is check out this forecast for your zip code. Because if we zoom into the zip codes, we have some big variations by zip code in terms of what we think our forecast is. But overall, at a metro level in Denver, we're thinking minus 9.7%. And when I say thinking, I mean that's what the data is suggesting. So if you are going to buy a house in the Denver metro, anticipate that those declines are coming. There's a lot of inventory on the market. I'm going to get some more cities here in a second, so stick with me, everyone, in this live stream. So anticipate declines coming in a market like Denver. Let's cover a couple other cities. What cities do you guys want me to cover here in this live stream? If you guys want to leave a comment, join as a channel member on this live stream. It's my channel members only who can leave comments. So join as a channel member. The cost is $5 a month. If you want to be a channel member, you want to participate in more of these live streams in the future, you can hit that join button. All right. What other cities should we cover here? Let's talk about Nashville. Let's talk about Nashville, the city that I just moved back to 2 or 3 weeks ago. Well, in Nashville, former boomtown, I'm going to call it a former boomtown because it's not really booming in the same way it used to. Values are flat over the last year. Values are flat over the last year in Nashville. They started decelerating. Price forecast is minus 7% over the next 12 months. Minus 7% over the next 12 months in Nashville. I mean, folks, this is a market. I talk to people locally here all the time. They still think it's going to go up. This is not a market that's going to go up over the next year. Heavy downward forecast. We're seeing days on market, inventory, price cuts all indicate prices will drop in the future in Nashville. Let's cover 1 to 2 more cities here. What cities do you guys want me to cover? Let's actually cover some markets where prices are forecast to go up. So a market like Chicago is super interesting, everyone. In Chicago, prices are up 3.3% over the last 12 months. I know people say that's crazy. How is Chicago going up when Denver and Dallas are going down? Well, it's because there's a flip going on in the housing market. There's a reverse migration occurring. We think prices in Chicago are going to go up 5.4% over the next 12 months in Chi-Town. Now, this is a big metro, everyone. So again, always make sure to check out your zip code level forecast because we still, we actually have some areas more on the southern side of Chicago. We think prices are going to drop. We have areas on the northern side of Chicago that we think are going to go up 10%. Areas that we think are going to go up 10% over the next 12 months on the north side of Chicago. So make sure to check out these zip code level forecasts in your area. If it's blue, that means downward forecast. If it's red, that means upward forecast. And if you want to, at any point in time, understand how the forecast is broken down, open the scorecard at www.reventure.app and then take a look at the segmentation of the data points that go into the forecast to see what is causing it. All right, everyone, we actually got a request here from a channel member. A new channel member is requesting St. Pete and Florida. Let's take a look at Florida, everyone, because I think a lot of you know that Florida is going down, right? Florida on a statewide basis is down 4.3%. If we zoom in here, we're going to look at Pinellas County. Pinellas County, where I just used to live until a month ago, is down 7.7% over the last year. 7.7% drop in Pinellas County over the last 12 months. What's our one-year forecast for Pinellas County? Minus 9.5% is our one-year forecast. So prices are already down 8%. Values are already down 8% according to data from Zillow. We think at Reventure they're going to drop another 9.5% over the next 12 months, given how much inventory is on the market, how long homes are sitting on the market, what the home sale situation is like. There was a request here for a specific neighborhood in St. Pete. Kenwood, I believe it's this zip code 33713. Our forecast is minus 8.1% over the next 12 months. The values are already down 7.2%. So this is an area that's already going down, Kenwood and St. Pete. We actually got another request here in the super chat. Carmel, Pebble Beach, and Monterey Peninsula area. Now, you'll have to let me know who said this. I believe this is in California, right? Carmel, Pebble Beach. Just confirm for me what zip code you want me to look at. But you can see down in Florida, Pinellas County, I mean, some zip codes here are already down 17% year over year. Unbelievable. Actual like major crash is like playing out here. And I don't want to say it's unbelievable. I actually predicted it when I moved down there a year and a half ago. And this is ultimately great news if you're a home buyer in Florida. This is what you want to see. You want to see declining prices. You want to see cheaper values, more affordable values. Now let's type in Carmel. Carmel. Is that in California? Yes, it is. Carmel in Carmel by the Sea. Now, interestingly, this is a zip code that's not showing up for us right now on Reventure app in terms of home value. We do have inventory statistics on it though. So let's take a look at the inventory in Carmel by the Sea. How many homes are on the market? Oh boy. So we have 19 homes on the market compared to a long-term average of 24. So inventory is down slightly from the long term. Let's look at home sales. How many home sales are here? 2 home sales. So this is like a very small zip code. I'm just curious, is this the zip code you care about, 93921, or is it like the surrounding area? Because it seems like this is a really small downtown area without much sales activity. Days on market is 69. 69 days on market, which is right around the long-term average. So inventory is a bit down. Days on market is average. What's the price cut rate? Price cut rate here in Carmel is 17% is average. So this seems like kind of, I'm just going to say like a market that's balanced. Let's see what the listing price is year over year. It says the listing price is up 5.8%. Folks, typical listing price of 3.9 million. I mean, this is a place with really expensive home values. However, if you look in the surrounding zip code, you could actually see median listing prices down 13%. So very important. Oh, Carmel Valley. All right, so Carmel Valley, which I assume is this zip code, median listing price is down 13%. Let's take a look at inventory. Inventory, though, is down 8% as well. This is an interesting market. It's a bit different in terms of like how expensive the prices are. Let's see inventory. 89 homes for sale, down from 97. Prior to the pandemic, there was 176. So our forecast for the Carmel Valley is flat. Price is stable year over year. We don't have a lot of inventory. The days on market is now starting to go up, but not by too much. Price cut rate was 28%, is now 18%. It's again, it looks like a balanced market to me based on all this data. What's the home sales activity? Home sales are lower than normal. So I would say this is a market that's probably very individual house by house, but overall, we're not expecting to see like a major crash here over the next year. Hopefully that helped answer the question, and hopefully that helped you guys understand as a buyer or investor the type of analysis you should do to understand what's going on in your market. So look at all those key data points: inventory, price cut rate, days on market, home sales. How do those look to the long-term averages? And then upgrade to a premium plan to see our price forecast at Reventure app. Do not buy a house at the end of 2025 or going into 2026 without knowing the price forecast for your area. You're going to want to understand if you're in a market where the bottom's about to fall out. If the bottom's about to fall out and where you're about to buy a house, you either should wait or maybe even better, negotiate hard, find a discount. If the bottom is about to fall out, you should be able to negotiate with sellers and get a better deal. Conversely, if your market's going to go up like Chicago, north side of Chicago, you shouldn't be expecting prices to drop over the next 3 to 6 months. It might be better to just get in now and buy before prices go up in the future. To access all the data I showed you in this video, everyone, to make a more informed decision, go to www.reventure.app. Let me just show you how to do that real quick. www.reventure.app, and just start by searching. Start by searching your area. You could type in your zip code. Here's the zip code I used to live in Austin, Texas, 78731. And start by just looking at what the home value growth over the last year is in the zip code. you could see here minus 4.6% in 78731 in the last year. This is a market that's going down, but you're going to want to find out, okay, what's the home price forecast? To upgrade to that home price forecast, it's $49 a month, which is ultimately a very affordable price compared to the cost of buying a house. This is a $49 membership that could save you $49,000. We've had some members use our forecast to actually negotiate much cheaper prices on houses. I would also recommend signing up for that annual plan. It's a 32% discount. You can lock in the annual plan right now for $33 a month on average. It's $399 up front, but ultimately it would give you access to the data over the next year, allow you to prepare and make a more informed decision. But let's just see real quick. If I log in here to my premium account on Reventure app, what is the forecast for the zip code I used to live in Austin? What is the forecast for the zip code? Well, this is another thing about going live, everyone. You move around and sometimes, oh, there we go. App was a bit slow there for a second. Our forecast is minus 3.8%. So you can see this is a zip code in Austin that we don't think is going to drop as much as some of the other ones, which we think are going to drop like 11%. So you're going to want to know that. So, folks, these zip codes are like a couple miles away. One is forecast to drop 11%, another is forecast to drop 3.8%. We actually have one more request here from a channel member from VK looking to sell my home in Windsor Plainsboro Regional School District, New Jersey. Is this the right time? VK, can you please give me a zip code to start with? But New Jersey is an interesting market. New Jersey is a place where home values are still going up. So in New Jersey, values are up 4.1% over the last 12 months. So again, folks, like there's this narrative that like the Northeast US is dying. Like there's this narrative like everyone's leaving the Northeast US, yet somehow New Jersey and New York are growing home values still at over 4% in the last 12 months. Well, what are we forecasting in New Jersey? What are we forecasting for this area? Was it Plainsboro, New Jersey? Let's see. Plainsboro, New Jersey. Plainsboro Township. So values in this area are up 6.7% in the last 12 months. You can see actually how strong New Jersey is in terms of value growth. 5, 6, 7% value growth the last 12 months. We think values, in this zip code, we think values are going to slow to 2% growth year over year. So maybe we are seeing a bit of an inflection point. We still think prices are going to go up. But I would say, to answer your question, VK, if this is your zip code, this would be a good time. This would be a good time to sell because we just went from a major seller's market to more of a balanced market. But I really encourage you to check your specific zip code on Reventure app. And when you guys make the request in the future, try to make the request with zip code so I can more easily check it out. But best thing for you to do would go to www.reventure.app right now so you could access all this data for yourself and perform this